So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be talking about how to convert a bull put spread into an iron condor. So let's start with the first part of this trade, which is entering into a bull put spread. The idea behind a bull put spread is that you're selling option contracts on the put side below where the stock is trading, hopefully seeing the stock either stay the same or potentially rally higher. Now, you could actually see the stock fall and still make a profit as long as it stays above your short strike price. So if we have a stock that's trading at $100, we might sell a 95 strike put and buy a 94 strike put to create a 95-94 bull put spread. The idea is we hope that the stock continues to rally higher or stays the same around 100. It can fall. As long as it stays above 95, we'll still make money. Now, when you want to start converting these into an iron condor would be when the stock starts to move against you. So one of the very easy techniques that you can use to adjust bull put spreads is to convert them into an iron condor. And why this works so well is that it takes advantage of the stock moving in the direction of your spread to increase the overall credit while not taking in additional risk on the trade. So it's a very easy technique that you can use to make an adjustment. So let's say that the stock is again trading at $100 and starts falling towards your 95 strike put option, which is your short strike level. In this example, if the stock starts to fall, what you could do is then sell a 100 strike call and buy a 101 strike call, basically selling the opposing or corresponding call spread. And that in turn would create an iron condor payoff diagram. Now, when you sell the opposing call spread, you want to maintain the same width of the strikes. So $1 wide spread, if you did a $1 wide spread on the put side. If you did a $5 wide spread on the put side, you want to sell a $5 wide call spread. And you still want to sell the same number of contracts. So if you sold 3 put spreads, you want to sell 3 call spreads. Now, when you mirror this trade with the opposing call spread side, it adds no additional risk to the trade. And what this does is that it only adds additional credit from the selling of the call spread. That additional credit then moves your break-even point further down and moves it away from where the stock is trading at this time. So again, it's a very easy adjustment strategy that we go through a lot here at Option Alpha. It's a very easy way to convert a bullish position into a more neutral position to hedge and protect it. And it's something that we've talked about a lot inside of our training courses. So you can just search put spread adjustments or iron condor adjustments on the website. We've got lots of videos, lots of case studies that you can go through and look at examples. As always, hopefully this helps out. If you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to play smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.